Hey, good evening, everyone. It's Terry Gardner from CJ Lawrence, a division of Apollon Wealth Management, coming to you from Midtown Manhattan on Wednesday, December 17th. As we wrap up the year, I wanted to make three quick points regarding stock valuations. First being that I believe the current stock valuation environment is not similar to the Nifty 50 period in the 1960s and early 1970s, nor is it similar to what we experienced as in the internet bubble of the late 1990s. The second, I want to make the point that PE multiples can stay higher for longer. And then third is that current multiples are high, but that the backdrop warrants it. So before I continue, I want to reflect back to my last video where I got some pushback because I made the point on earnings growth that 4 consecutive years of earnings growth was positive for stock prices. The pushback that I got was that the S&P 500 has a high concentration of a few stocks at the top that were inflating the earnings outlook for the index. Point well taken, but I would point out that if you look at the S&P 500 equal weighted index, the earnings growth picture for that index, which weights all the companies equally, is quite robust as well. Earnings growth this year will be about 7%, a little shy of the market weighted index, but next year earnings are expected to grow 11% and then 13% in 2027. So the earnings picture is robust, the earnings growth picture is robust across the broader market. So let's get back to my point on PE multiples. My first point being that the current environment is not similar to the Nifty 50 period of the 1960s, early 1970s. For those of you who are not familiar with the Nifty 50, it was a group of 50 stocks that were assembled by a firm called the Morgan Guaranty Trust back in the 60s that consisted of a group of high-flying, very consistent growing stocks. Their thesis was that these were the only 50 stocks you needed to own, and you could own them forever because they would continue to grow, okay? And so the multiples on these stocks continued to inflate through the 60s. I'll give you a couple of examples. The average for the index in 1972, when the Nifty 50 started its descent, was around 43 times earnings. The current multiple on the S&P 500 on forward earnings is about 23. So a little more than half. So not comparable to that inflated period of the Nifty 50. A stock called Polaroid, which some of you may not even know, was trading at 91 times earnings. McDonald's traded at 86 times earnings. Disney traded at 82 times earnings. And Coca-Cola at 82 times earnings. So as you can imagine, those are not the types of multiples that we're seeing in today's market. The thesis of the Nifty 50 broke in the early 1970s with the onset of sky-high inflation and slowing growth. And that is not the backdrop that we have today. So I don't think the comparisons of those sky-high multiples of the Nifty 50 with that backdrop is comparable to what we're experiencing today. Okay, so okay, you may ask, well, what are the multiples on some of the higher flyers today? I mentioned the Nifty 50 names. If I look at some of the Mag 7 names, NVIDIA is trading at 24 times earnings on 2026 forecasted earnings per share, according to data from FactSet. Had been over 50 times, so it's come down meaningfully. Meanwhile, earnings are expected to grow 63% next year. So that's a pretty attractive multiple on a lot of respects. Microsoft is trading at 27.3 times for a very consistent double-digit earnings grower. Google is trading at 27.3, Meta 22.1, and Amazon at 28 times. Remember when Amazon was trading over 100 times? Everyone suggested it's so overly inflated. So you can see just from those couple of names that I just mentioned versus the Nifty 50 names, there's no comparison. So how about the internet bubble? You hear that period of time referred to often in the press as being similar to where we are today. In 1999, the NASDAQ 100 traded at 60 times forward estimates. Okay, that's 100 stocks. In that year, there were 370, in just 1 year, 370 IPOs. only 14% of them had earnings, okay? 81% of those IPOs had sales or revenues below $100 million. So all small emerging companies that really didn't have, in many cases, a business. The most profitable companies during that period got sky-high valuations. Cisco's PE fluctuated between 105 and 200 times earnings. Qualcomm traded at 128 times earnings. Lucent traded at 90 times, and Sun Micro at 85 times. So you can see, again, the comparisons aren't even close. Companies like Webvan, Pets.com, eToys, and my favorite, Boo.com, traded on multiples of eyeballs and clicks, not on sales and revenues. In fact, during this period of the late 90s, I was an equity analyst covering the transportation stocks, particularly freight railroads, and some of my competitors were actually starting to add value to the railroad franchise value calculation based on the amount of right-of-way that the railroads own. The right-of-way is the land that the rail actually sits on, and to both sides of it, those easements are owned by the railroads. The thesis was that that is property under which fiber optic cable can be buried to transport all this new internet traffic. And so analysts were adding that value to the railroad valuation. Now that's a bubble. Now, yours truly certainly would not have participated in that type of valuation exercise, but from what I understand, others did. Nonetheless, so it comes down to these comparisons, and really there's no similarities between that 1999 period nor the Nifty 50 period in the 60s. Okay, the second point on valuations that I want to make was that valuations can actually stay high for long periods of time. Okay, and the point is based on the fact that information is everywhere, and information is what we're using to get comfortable in owning stocks, right? So if you think about the essence of information flow around corporate events and corporate earnings, it's constant and consistent. There's quarterly earnings conference calls. There's transcripts. Companies are forecasting their earnings and giving guidance. There's information from various sources on the internet, all which can be absorbed and used in a calculation and a forecast of the future. All of that information coming from the companies, outside sources, can be used to get comfortable with the progression of earnings and the progression of where the future of the business is heading. When you compare that to what to information that analysts and market forecasters used to get, it's night and day. When you think about back in the 1990s and prior to that, we were happy when the fax machine was invented so that we could get real-time information off of a fax machine. Prior to that, we were getting information in the mail. This is an old S&P book that was sent out monthly to update analysts on S&P 500 and subsector and industry earnings, sales, and dividends. Every year we got an annual book from the S&P, and we would race to update all of our models when these things arrived in the physical mail. So we've come an awfully long way, and my point is that information flow, access to information, the guidance from companies, the visibility we have on the future of the business is contributing to a comfort level that is allowing investors to pay a higher multiple on earnings, higher PE multiples, okay? So thirdly, and finally, the current environment is conducive to high multiples. When you kind of tick off the list, earnings growth is accelerating, profit margins are expanding, free cash flow growth is accelerating. That's not a story you hear in the market much these days. In fact, what you're hearing is that all of these big CapEx spenders are depleting their free cash flow. Well, the story isn't necessarily accurate when you look at free cash flow forecasts for the S&P 500, which on average, free cash flow growth has been about 7.5% 8.3% over the last 15 years. Be a little lower this year for 2025, 3.6% free cash flow growth. But next year, that number is accelerating to 19%. And another 19% free cash flow growth in 2027. So the free cash flow story is, I think, a really one that's not being focused on in the market and is an important one to tell. Interest rates are likely moving lower. We saw the Fed move last week. Inflation is hovering around its long-term average. Companies are innovating and driving new product and business cycles. These are all things that are contributing to an environment that fosters higher stock multiples. So the message is, yes, PE multiples today are high versus most historical averages, but for good reasons, and multiples can stay high for a long time. So there's plenty of risks to focus on in the market, but we don't believe that high multiples are near the top of that list. So if you have any questions, give us a ring. My number is 212-888-6403. My email address is terry.gardner@apollonwealth.com, and look forward to hearing from you.